So whatever's coming, and I can't tell you what it looks like before it occurs, but I think what's coming is that the dollar is going to get smashed to the downside. And I think that's what all these charts are suggesting. And I think gold front ran whatever they're going to do next. I find it very difficult where the 10-year yield's been falling here recently, just very recently, that they aren't in there doing some of this. That's, or something's in there because you have to buy a lot of bonds to drop these yields this amount. So I think that they're in there saving maybe the yields from moving on up. And he put the line in the sand right where it's at. People are dumping bond market and they're dumping the dollar. And that is a very bad sign for Americans.
You're watching Capital Cause, and my name is Danny, and it is April 29th, 2025, and today's guest is Andy from Finding Value Finance YouTube channel, as well as I believe you also have your own service as well, Andy. We'll have the link to both of those down below. Andy, thank you so much for coming on the show, my friend.
Yeah, thanks for having me back on, Danny. I really appreciate it. So thank you.
Yeah, Andy, we were just talking about how you like to leverage technical analysis and fundamental analysis. You're more of a hybrid. So I want you to, before we get started, let's go ahead and talk about what is front and center for you right now. What is the most topical news item that you think investors watching this program should be most cognizant of?
Yeah, so I approach the markets from a long-term perspective. I look at it from the big picture moves. So if you can size the big moves up, you can get the big gains, so to speak. So that requires me to take a little bit longer viewpoint and time frame investment approach than say somebody who's playing it on a month to month basis. So I look at something like a decade to decade. I look at the cycles. So my approach, my view has always been from that longer, bigger picture view. And I think commodities just in general look absolutely great because of that longer term view. Now in the short term, there's some stuff coming that could be a little bit ugly with these tariffs and some maybe disruptions, could be some shifts in the economy. We could see some unemployment kick up. We could get a recession. That's all possible. But I view things from the longer, bigger picture view. I use the short term market gyrations and fluctuations to get good entry points for the long term, bigger picture view out there. So nothing's changed in my viewpoint. I still think that commodities are cheap to financial assets. In particular, precious metals look fantastic. Commodities in general, like the coppers, oils, all that stuff, fertilizers, they're very cheap. They're cheap on a financial perspective. When you look at financial metrics like price to book, price to earnings, they're cheap against the other assets and other potential investment opportunities out there. They're cheap. So nothing's changed long term, but short term, there could be some rockiness ahead of us when you start to look at like the yield curve that's starting to uninvert and stuff like that. You might see a weaker dollar here shortly. So I still take the big picture view, take advantage of the short term fear, take advantage of all that stuff. And in the short term, yeah, we could see some rockiness for sure.
Yeah. So in terms of rockiness, are you referring to the dollar? Are you referring to the market? What exactly are you referring to? And I see you've got a chart laid out, ready to go regarding the DXY. Feel free to pull that up whenever you're ready.
Yeah. So rockiness. I'm going to start with the 2 and the 10, and let me see if I can. Yeah. So there's the 2 and 10 yield curve. I want to back out so you guys can see it. What generally happens is you get these big cycles that go up and down. The yield curve, I've got this as 2 and 10. Some people put it as 10 and 2, and it's inverted. But when it gets up to this level up here at the top there, that's when the market gets a slowing of inflation. Fear generally creeps up. People start positioning back into the bond market. And then the yield curve starts to, we call it uninvert. So this is inverted up at the top. Then it uninverts and comes back down. when that comes back down, that's generally when we see fear in the market, problems in the market. Back here was 9/11. Back here was the housing crisis or the great financial crisis. C19, people were piling into bonds starting in September of 2019. It was starting to go down. And then you can see the big pile in March of 2020, Feb in March. So you get these events that almost always occur when the yield curve starts to uninvert. We are seeing the yield curve kind of dive down here. We're not dropping like a rock like we've seen in history. That's something that I would be watching. So what that generally means is that the 2-year yield, people are going to pile into that, or they start to lower interest rates dramatically. The Federal Reserve does. The Fed funds rate just basically does whatever the 2-year yield does. So if this starts to drop down dramatically, most of the time that is people front running an event. And the smart money is more or less just insiders who have information from the inside out. They're not necessarily smart, but they have insider information, and then they position themselves before everyone else. And that's what we're looking at, is the positioning of those guys into the market. Now, when this does drop, or if it does drop, generally what you see next is you'll see a weaker dollar as yields start to drop. Money will start to flow out of financial dollar-denominated assets. So we can look at other things like perhaps the Canadian USD. And what this is this is your Canadian dollar versus the US dollar. So we started with the yield curve inverted, potential slow weakness in yields, which will result in a potential weaker DXY. And then you start to see other currencies get stronger against the United States dollar. The last bull market of commodities is that circle there where the Canadian dollar outperformed the United States dollar. And you see these 3-hump consolidations and falling wedge formations. I think that eventually this will break higher, and that will ignite another bull market in commodities and emerging markets and Canadian markets. And that's money rotating and shifting in the markets.
And that's because Canada such a resource intensive, I guess, country, right? Because when these bull markets and commodities do occur, you have all these Canadian mining companies and Canadian energy companies. I mean, they're all based in Canada. Not all, but a lot of them are. So then when investors seek out to deploy capital in that sector, they've got to buy Canadian dollars in order to position themselves within those stocks. I think the same thing with Australia too, no?
Yeah, so the Australian dollar, I've got it just underneath here. It's got the same setup. So the last bull market was this big move here. We've got a 3-hump consolidation. That's the big consolidations of a falling wedge. And then we got a breakout here. Basically, it's just waiting for a weaker DXY. So to sum this up, here, I'll pull up the DXY and I'll take a big picture view. The bull markets and commodities is where it says bull. And this is weaker DXY. So ultimately, commodities aren't necessarily going up. It's the dollar going down, and commodities are priced in dollars. So that's ultimately what it is. And then money shifts and flows in the markets based off of the currency exchange rates. So money leaves the dollar when the dollar starts to go down. And then it seeks other currencies that are stronger than the dollar. That's why I was looking at the Canadian dollar versus the US dollar. And when that starts to break out, money flows towards it. And commodities benefit because you get a weaker dollar, and that's your bull market, in my opinion. So that is something to look for as a potential outcome, is if we do get a weaker dollar, and that's exactly what Trump and Bessent want. They've stated that multiple times. They want specifically a weaker 10-year yield and a weaker dollar. I'm not sure if they can get it as easily as they are just saying it. But if that does transpire, that's where your commodity bull market and emerging market bull markets come from.
Now, if that doesn't, Yeah, if that doesn't occur though, if they aren't able to get the 10-year down, can we still have a commodity bull market, or is the commodity bull market dependent upon that condition?
Well, I think it is dependent on a weaker dollar, but you can have interest rates go up and the dollar go down at the same time. So that is very much possible. And right now, yields are, there's the 10-year yield, and I'll change this here. So this is kind of a long-term 10-year yield. You can see we were in a secular downtrend, turned into a secular uptrend,
Hmm.
secular downtrend, and that ended in September of 2021. You got a nice little shoulder, head, shoulder, inverted, um, nice little inverted shoulder, head, shoulders pattern. So that's a bottoming pattern. We started working our way higher, and I think that we are now in an uptrend for interest rates. And if you guys want to see something real crazy, what I'll put on here is, yeah, not too many people know about this, but I'll share it since I'm on the channel here. So this is the price of silver, and I'm
Wow.
sure you guys can see something that is similar here, right?
Hmm.
So your consolidation, this is an upward bull market in silver versus the 10-year yield. Your consolidation is your downtrend in interest rates. You can see that there, and we'll probably break higher with interest rates being the driver of it, in my opinion. So interest rates are the driver of money rotations. It's one of the drivers where money leaves the bond market. And then eventually, if rates get high enough, I think the special rate, so to speak, is around 5%, 4.5%, 5%. If it gets to 4.5%, 5%, which is roughly where we're at, you'll start to see the S&P 500 and NASDAQ roll over too. So then you've got two areas where money is exiting the market. And if you get a weaker dollar on top of it, you've got money leaving the bond market, money leaving the financial stocks like S&P and NASDAQ, and then it seeks alternatives. Those alternatives are gold, silver, and commodities. And you'll have the most amount of money seeking safety away from the assets that are underperforming that they are in, and looking for potential opportunities in other financial markets and sectors and assets. So that's kind of the sweet spot, in my opinion, is when you get interest rates moving up and the dollar moving down, where commodities and precious metals go ballistic. I think silver looks fantastic. Gold's already running quite well. It's had a pretty big breakout. I think silver's just lagging behind it when you look at this big picture view. And obviously, I've taken my positions already in this. So that's kind of how I view the markets. I view it from this bigger picture view, backed out like this, and then I take positions, on the right hand, basically the right hand in this entire area down here is kind of where I'm doing it, and I take it from a multi-year, decade approach, or even longer than that. As this breaks out, we're going to get a big, big, big move over a very long period of time, based off of these conditions that are changing.
Could
So,
you could you ascertain the same relationship between the 10-year and gold as well, or is this more so exemplified with silver?
well, the reason I'm using silver is that it was freely traded back here.
Mm,
Gold was not freely traded in the 40s, 50s, and 60s. It was held. And I think that gave it a bunch of pent up demand when it was freely traded in the early 70s.
I see.
But yes, I think gold's in the same situation. And I think it will do exactly the same as silver. But I don't think it will go up as much as silver. I think silver is going to do some crazy stuff. Whenever we start to break, I'd say through 35, 36, 37, somewhere in that range, we get basically all the resistance below us. And then I think we'll just sail. But I'm sure a lot of people don't want that to happen that are a part of the banking system. They are heavily short all this stuff. And that'll just add to the fuel, to the buying power, so to speak, as they have to cover their shorts at some point. It could have a problem. If we do break out and it just starts to move rapidly, maybe those banks have problems and they go bankrupt or something like that. If their positions aren't unwound, which I don't know how they unwind them, but yeah, it applies to gold as well. I think gold will do incredibly well over the next however long interest rates continue to go up. And it's possible that interest rates go up and never come back down. It's a game-ending currency move, perhaps, however long it takes. So that's what would get me very bullish on precious metals and physical metals and out of the system.
It's kind of counterintuitive because we've been led to believe that higher interest rates provide a headwind against the precious metals because that means that there's greater rate of return on bonds as opposed to precious metals. But what you're saying is the opposite, right?
Yeah. So what I'm saying is when the debt gets piled up large enough, they try to inflate their way out of the system, and you still have real negative rates. So back here, they had higher interest rates, but they were still negative in real terms. So the inflation rate was still greater than the interest rate that was getting paid on the bonds. So people continued to move out of the bond market and into the alternative markets like precious metals. So that's still all intact, and I think it's still going to happen again.
Gotcha. What about the gold to silver ratio? We're sitting at about 100 to 1 gold to silver. Do you think that continues? So it sounds like you think that'll mean revert at some point. You don't anticipate it going back up, because I've heard other analysts out there say we could reach as high as 140 gold to silver ratio. But what's your take on the current allocation between global capital allocation between gold to silver right now?
Yeah, so I think the market conditions is driving money into gold based off of the safe haven asset that gold is. So this is a ratio that is telling us what the market conditions are currently at this time. Lots of uncertainty. Gold is a safe haven asset, so people are seeking safe haven asset versus, say, silver, which is less so a safe haven asset. So I think that it's 100% a function of what the markets are going through and the people are subjected to and what they're feeling at this moment. So you could also do a platinum to gold ratio, which is another sign of fear versus, say, a strong economy and inflation getting kicked out of a strong economy. So this is basically saying we have a weaker economy. At least that's what the markets are telling us and what the ratio is telling us.
If you're looking for great deals on gold and silver, coins and bars from a company that you can trust, then you've got to check out the good folks over at Pimbex. This year, I've really gotten to know these guys, and all I can say is you're not going to deal with a better group of people. They're a family-owned gold and silver online bullion company offering the essentials and more at industry-leading prices while always providing first-class top-tier service. That's PIMBEX.com. And if you're looking to convert some or all of your retirement account into real gold and silver, give Pimbex a call. They'll help explain the process and get you started on the right path. Your support at Pimbex also helps support the channel. So reach out to Pimbex today. You won't be disappointed. And make sure to tell them Danny sent you.
And that there's fear in the market and that people are positioning in gold more so than silver based off of what the herd is being subjected to in terms of market conditions.
Right. So looking at this chart, when the gold to silver ratio hits a high like we're hitting today, that implies that silver is, from a probability standpoint, most likely a better buy versus gold, and then vice versa when the ratio hits that lower section of the chart. But if you look at 2020 and beyond, we've been in this buy silver zone, but gold has been the outperforming asset between the two.
Yeah, so I think I don't know the exact bottom of this, and if it gets above 100, like basically where we're at, I would be a buyer of silver. Your best entry points is when there's the greatest amount of fear in the asset that you want to buy. But it's obviously very difficult to get the exact bottom So you might want to figure out strategies on how to cost average in or something like that to get a whole bunch of cheap, whatever asset you want to acquire, get it at a very good price. So it doesn't mean that you put all your money in one shot and just blow it in one buy. You might want to buy it over, say, a 6-month period or something like that, where you get 100+ ratio and you just keep peppering it in, getting that asset at a very cheap price. So yes, when things hit certain ratios and they get cheap enough, and you think that there's a great amount of fear in the market, that's generally the best time to act. But it's very difficult to do that because all of the news articles, all of your buddies, everyone on YouTube, most likely is going to tell you it's a bad purchase, and they'll be just talking about relevant current information, maybe perhaps not about the 12 to 18 months that's ahead of us. That may look a little bit different than what people are feeling today. So to get really good entry points, to get close to the bottom, I would be looking at silver right now. I also think that the chart of silver priced in dollars looks pretty dang good. It's a big cup and handle that we're trying to break the right hand side. So I think this is a fantastic opportunity for silver to acquire it, the physical metal, and even the mining companies as well at this time. Yeah.
And you also said platinum to silver. Was that another key ratio you look at too?
Yeah. So when we look at, I'm going to do platinum to gold. Platinum to gold's at a really, really low ratio right now, 0.3, which means basically gold can buy about 3 ounces of platinum. Historically, that is incredibly cheap. But I also think this is saying that the conditions that we are facing is a weak economy, and there is fear in the market. So that's another thing that we are seeing today.
Well,
Is
what does platinum imply? Like, what is the platinum price? Like with copper, it's correlated. It's correlated with the economy's health. With silver, it's industrial, and it's an industrial indicator of industry. What about platinum? What's the takeaway from
it?
platinum?
It's very similar to copper. It's roughly the same thing, and silver. They're all interconnected. They're all very similar. They do move a little bit different during different times. They're not all 100% correlated, but they're all saying roughly the same thing. Copper has been going up. That is experiencing some shortages, I think, over in China. They're pulling more copper than what I think they're getting, so prices are remaining quite resilient. Um, platinum Platinum is down, and I think it's very similar to silver. The ratios are both peaking at very, we'll call it anomalous times in history. This is the cheapest it's ever been, and silver's up there too, one of the cheapest times it's ever been. And I think that's just saying that they're running into gold, and there's also the conditions that people are running into gold, and they are seeking safety as a safe haven asset. So I think when the dollar starts to fall, and we start to see a lot of other commodities, like even oil is pretty low right now, and I think that's also similar to platinum. They all kind of move together, and there is a strong correlations between platinum and oil. So right now they're very cheap. So we're in this era or area where there's fear in the market, and this is the bumpiness that I'm seeing in the market is coming from you're adding all these charts up of what you're seeing, the pricing of all these ratios and where they're located. And the bumpiness that I'm seeing is a function of how people are positioning in the markets. So I don't think it may not have bottomed yet. We have to wait and see. But when it gets to certain ratios, I start firing off buy orders just because it's so cheap. It's kind of a Warren Buffett approach. That's what I define myself as, the hybrid investor. I use technicals and fundamentals. Fundamentals are mainly around valuation. And when you get to certain valuation points, it's like, you know what? We're underneath the cost curve. Production's pulling back. We're at these ridiculously low ratio levels. And then that's what makes my decision, is just I just start to accumulate. So
Interesting. So what about gold relative to the S&P? Because it seems like there will come a point or may come a point where general investors move out of the broad market into this capital rotation event, where capital rotates into gold, silver, and resource-based assets. I see you've got the gold to S&P ratio down there. It looks like gold is
We'll do a longer term view with more data.
Yeah. Well, we just talked about this yesterday with my good friend Mario and Echo, and we looked at that same chart. But I want your take here. I mean, what is this chart telling us?
Yeah. So over time, you have these assets that move from one, financial assets to hard assets. Hard assets, when this ratio goes up, gold's outperforming financial assets. So these areas is where you want to be positioned, is commodities and precious metals as these break out and move higher. I've got this upper trend line that I kind of cut off the 1970s here. I think this was probably maybe a little bit overblown, maybe. Hard to say. Sometimes I cut through things and say, it's kind of like it's a falling wedge. And if we break out of this, it's going to be like the ultimate commodity bull market we've ever seen. But what this is saying is that the markets on these long-term cycles, they just go from overvalued to undervalued. And then this would be undervalued gold down here. And then it's overvalued financial assets. Undervalued financial assets are at the top, overvalued financial assets are at the bottom here. And then money just flings back and forth based off the market conditions, to and from hard assets to financial, back to hard, back to financial over time. This is just a really long cycle. So, assets are at the top, overvalued financial assets are at the bottom here. And then money just flings back and forth based off the market conditions, to and from hard assets to financial, back to hard, back to financial over time. This is just a really long cycle. So, you kind of look at the cycle going up and down like this. And I think we're going to go into an upcycle here just recently. And all of your financial metrics, price to earnings, price to book, all that stuff. If you look at financial assets, they're expensive. You compare financial assets in relationship to GDP. You do all these different financial metrics. They're all expensive in financial assets. You look at the hard assets, they're all cheap. So I think the cycle is just starting to rotate. Gold is what's leading this cycle maneuver, we'll call it, and gold's broken out against the S&P 500. Another very similar chart to this, because what you're going to start to see is you'll start to see confluence of a whole bunch of different data that starts to match up over time. You can also look at a long-term crude oil chart, like U.S. oil divided by the S&P 500. And it's the same, it's a very similar chart. We are squeezing into this corner here. And that's one of the reasons why I cut off this top, even in gold, because you've got roughly the same squeezing across multiple asset classes against the S&P. So, and then you can see that we are squeezing into this corner here. And I took this repeating patterns over different time frames. We call them fractals. So here's a fractal. This fractal is the 1968, or I should say, 1968 to 1980 fractal. And I just overlaid it on top of this. And you can almost see it's almost a perfect overlay. You can see how the fractal moved and how the herd positioned into it before a very large move to the upside. I think that what's going to drive this is money rotation out of the S&P and money into oil based off of the dollar and the value of the dollar. So whenever's coming, and I can't tell you what it looks like before it occurs, but I think what's coming is that the dollar is going to get smashed to the downside. And I think that's what all these charts are suggesting. And I think gold front ran whatever they're going to do next. So gold, this is the gold price. This is the front running of that move. And it's the breakout of basically this big cup and handle
It's the
that
leading
broke out.
indicator. Yeah.
What's that?
I said it's the leading indicator. You had something similar in 2020 where gold rose before anything else, and then commodities ran hot a year later.
So it broke out here in 2019, but the bottom of it was in 2018 here. So the bottom of the move, this is the bottom of the move. It's a very similar fractal. So the fractal is, all a fractal is, it's like the genetics of humans interacting with each other. So it's like the genetics of my hand. And you would say, oh, a bigger palm has bigger fingers, generally speaking. So a very small palm with gigantic fingers. I mean, females do have, I think, a little bit longer fingers than their palms than males do. You can double check that. I didn't check that, but I've seen a lot of. Seems like they have longer fingers. Maybe it's because of the nails they put on, but
I'll take your word
it's
for it.
that it's that genetics that I'm looking for, and that's what a fractal is. A fractal is just kind of what the movements that get produced by humans, and you can kind of overlay these things, and they're very similar. You know, this one's just all squeezed up. So this here is the move before that big takeoff, and that's the same move as that was down here before the big takeoff. And then when it seems like during the fearful areas where the yield curve comes up and starts to roll over like we saw earlier, that's when these make their advanced moves. In all of these areas, a lot of them were making, that's kind of like the initial move where these initial moves started. It's when the yield curve was up, and I'll show you guys what that looks like, so you guys can see it yourself. So here's the 2 and the 10 yield curve. I've got these nice green lines on it. So I'm going to put XAU USD underneath it. And then I'll put it on logarithmic so you guys can kind of see. So when this inverts here, that's a real good time to be looking for a potential purchase in gold, right when it just gets all the way and peaks out. And then gold starts to bottom and start to move higher as we move on up. We can see another one here where we bottom, we were consolidating and bottomed right when we hit, and gold started to move on up again. Our consolidation, when it came back down, you could see it consolidate for a period of time. And then we took off again as it went back up. So I think what's occurring, it earns its safe haven asset. It earns its safety, investment or asset class based off of where the yield curve is at. And then we get oil and gold kind of just going back and forth based off the conditions of inflation or disinflation in the system. So I think they just transfer back and forth. And you can create, strategies and portfolios around some of this to balance the portfolio in different market conditions without having to try to time it perfectly. So you can get your gold and silver assets in certain areas, like now, so to speak, and then your oil assets when it kind of pops down, like we've been coming down. You can start to buy those after gold is run and silver's run. So I think there's a lot of value there. You can balance a portfolio where you don't get insane volatility trying to be in one asset class or just a few asset classes.
Fascinating. What about, so you mentioned the oil price. I want you to look at oil relative to gold, or oil, or better yet said, oil priced in gold, because it seems like it seems like oil is still lagging behind. I mean, it doesn't seem to have gotten the program right. I mean, why is oil the master commodity, the key to all other commodities themselves? If we are to be heading into this great capital rotation event, why hasn't oil gotten a bid yet?
Yeah, so I think the ultimate bottom in oil was 2020, and we broke out of this big consolidation, this falling wedge, I'll call it. It broke out in 2021, and then we are doing another kind of consolidation lower here. It's broken lower. I mean, obviously, you can do a kind of another falling wedge, so to speak, but then we're doing like this big false breakout. to the downside. I think eventually what it will ultimately turn into is an inverted shoulder head, and then we're probably scribing out the right hand shoulder here. So this here is an inverted shoulder, head, shoulder on this ratio. And I think eventually we'll work our way on up. Something on the lines of that. If it doesn't scribe out that inverted head, shoulder, then we're still at an incredibly cheap ratio here, way down here, where we're almost as cheap as we were back in 2020. It's getting pretty close. So oil is the master commodity. I call that the master commodity. I call it the master commodity because that's what created our current modern civilization. It's what modern society was basically built off of, is oil and the energy from oil and all the products that we receive from oil. But during certain market conditions, oil doesn't do as well as, say, gold because they're a little bit different. As inflation kind of comes, it peaks and starts coming back down, disinflation, so we have lower rates of inflation. Generally, that's where gold starts to wake up. And oil does really well when you've got increasing inflation. And what we're kind of waiting for is that M2 money supply to kind of kick back up, which we have done, and get into the system. So that kicked back up back in October of 2023. So you can see we rolled over. They had some money that they kept pumping into the system from the reverse repo, which I don't think this will come out as deflation. I know some other people look at it like, is it Steve Hanke? Remember that guy is, I can't remember his name, but he thinks that the money supply is what's driving the economy, which I agree, he's definitely not wrong. But I think the reverse repo was pumping money into the system in the background. So this turned upward. The reverse repos basically drained or very low. This kicked up in October and December of 2023. It turned and started going higher. I think that this is starting to work its way into the system at any time here. It takes about 18 months-ish to work its way into the system and be felt in the system. I also think that gold is probably front run this. I think Bitcoin and Ethereum are probably sensitive to this too. And this is coming.
That's a very good insight, actually, because I suspect if you were to juxtapose the gold price onto this chart, gold really began its bull market again, I believe, in the same time you started seeing this M2 money supply rise, right? Like around late 2023.
Yeah. So gold bottomed in September, October of 2022, which was right here. But that's also front running a lot of this stuff. So it's insiders positioning. They know, like the banks, stuff like that. Gold goes up when other asset classes go down. And so when you look at the bond market, see how we have this peak in bonds? This is bond prices. We have this nice shoulder head shoulder. It's the same inverted shoulder head shoulder that we saw on yields that I showed at the bottom there of that long 10-year yield chart. So this is a top, I think, and we've broken through a lot of these uptrend lines, these long-term uptrend lines. It started in 2010. And we've been heading lower, lower, lower. And what that means is money is flowing out of the bond market. And bond prices are coming down and yields are going up. That money coming out of the market has to go somewhere. So where's it going to go? And if rates continue to go up, I think at about 4.5%, 5%. The reason I'm taking 4.5%, 5% on the 10-year is when the markets go up, the S&P and NASDAQ, they'll go up and up and up and up, even with interest rates going up to a certain point. That certain point, when looking at history, is about 4.5% or 5%. At that point, the correlation between interest rates and the stock market become opposite. So if rates continue to go up, the stock market will start to diverge and go down. And we're right at that exact point. It's of no surprise that Bissent came out in some of his tweets and said, we will hold the line here at 4.5% of the 10-year yield. So I think QE could come, quantitative easing. I think they could maybe even already be doing some of that. Hard to say. I mean, I find it very difficult where the 10-year yield's been falling here recently, just very recently, that they aren't in there doing some of this. Or something's in there, because you have to buy a lot of bonds to drop these yields this amount. So I think that they're in there saving maybe the yields from moving on up. And he put the line in the sand right where it's at. So I was like, well, he came out and said it, and he's probably doing it. I'm guessing. That will put pressure on the dollar though, to head on lower. If he has to punch it enough to keep it down, buy enough bonds, it's going to put pressure. See, basically, pressure is mounting in the bond market, and they're going to transfer that pressure to the currency if they try to save the bond market. And if we do save the bond market, if they do QE and they hold interest rates down and maybe even get it lower, it puts all the pressure here. And then you'll see Canadian dollar and all those other currencies go up against it. So it's all kind of interconnected. And I'm just playing the big picture move, which is commodities, precious metals on up. And I think that the driver is this guy here.
Well, why do you think that the market saw, I mean, crash is a strong term, but when we had that big correction 3 weeks ago, after Liberation Day, everything sold off. The market, the stock market, the bond market, the dollar. I mean, the dollar sold off, but foreign currencies rose in the process. Gold actually held fairly strong. Conventional wisdom will tell you that when the stock market goes down, the bond market tends to capture some of that fleeing capital. It didn't happen this time around. Why do you think that was?
People are dumping bond market and they're dumping the dollar. And that is a very bad sign for Americans. It means that, so when you look backwards, the safety play, so if we go into a recession, if there's a slowdown, people generally run into bonds, and you'll see the dollar go up, the DXY, it'll get stronger. So if you were to kind of go back and look at the case of 2020, oops, that happens when I try to grab and move. So here's the event of March and April of 2020. You could see people had this big reaction where they ran into the dollar, and it provided strong dollar strength. At that same time, people also ran into yields. So you'll see the 2-year yield drop like a rock here. So here's March, so February, they front ran it. And so people are running into bonds. And then you can see in March too, it just kept going lower, lower, lower. And then we eventually bottomed basically in May of 2020. So people ran into the 2-year, they ran into also the 10-year yield. I gotta get it in 2020.
And this all occurred before 2020. I mean, this all occurred before the big event.
Yeah, it means people knew it was coming, is what it means. So you can see we peaked in December of 2019. And then you can see a big move in February. That's people front running what the Fed was going to do and probably shut down the economy or something. So money was rotating into all this. But recently, your observation is when that event, that Liberation Day event occurred, we got an opposite response almost, where yields surged. They surged higher. It means people didn't run to bond market for safety. They ran away from it. And the dollar also, it went down. You can see here, this is March, and then we went into April. You know, it went down, not up. So I think people are running into other assets for safety. And that gold's a primary example. And I think that's also why we're seeing the outperformance of gold versus a bunch of different commodities too, like platinum and silver and oil and all these other things. They're running to safety. And that's the benefactor now. Things have changed to that degree. And there's no way I would buy any bonds myself. So I don't know why other countries would buy our bonds, a 10-year or 30-year bond. Like I don't see why people would do that. They know that we're going to have to inflate, and everyone I think sees that. So what are your alternatives if you're not going to buy bonds? If interest rates spike, it's going to put a lot of pressure on the stock market and financial assets as we get above 4.5 and 5. If they spike, you're probably going to see a downtrend start in the S&P 500, and I think it's probably already started. You can see that we've got pretty good selling pressure in this kind of first leg lower there. You got this kind of big top, it's turning over. And now it's a big question mark of where this thing's going to go. Are we going to do like a double top? Is this potentially a bull trap is what they call it, which is it's like a second peak. Sometimes it could peak right where it's at. It could peak right here. Sometimes they do double tops. It all depends. You don't know until you look backwards. Sometimes even the peak can be higher than this here. It can run a little bit higher and then roll over. So I'm not going to claim that I know exactly where this thing's going to peak out, but this is going to be driven by interest rates and the dollar. And if interest rates continue to go up, this thing I think is going to eventually roll over. And then money's leaving two gigantic areas of the bond market and stocks and need to find a new home. And the problem is finding a new home of where this is going to migrate into. There isn't that many options that can absorb that amount of money. So you're going to start to see, gold and silver and these things they'll move massively because it's a gigantic amount of money looking at very small markets on how to position in what could be a new paradigm for the next, say, decade plus. But that's where you get the commodity and precious metals. I'll say bullishness on those asset classes versus these other ones, and the valuations all align with it. The market conditions align. Everything kind of aligns from the technicals. These big long-term falling wedges. We're just very early in this big transition, and it takes a long time. A lot of people think that this is going to take, a few months or something. It doesn't work that fast. It takes years for this topping to kind of top out and roll over. It takes years for these big bottoming patterns to develop. And then once the trend is established, you're going to get a big move. It's kind of like buying these stocks in 2009, like NVIDIA and AI. They bottomed in 2009, but in the beginning of it, they had a lot of consolidation still. So 2009 was the start of this new cycle, or say the old cycle that we're basically maybe ending. We could still get one last surge. I mean, it's possible, but this was the beginning of the cycle here, and that's where I would have been accumulating. Maybe not NVIDIA. Maybe I didn't know about NVIDIA and how good it was, but potential tech stocks and other insurance companies and all sorts of stuff down here when it was cheap. And then this was the ride that I'd want to ride. I think that this is going to turn and head lower eventually, and then commodities will be the outperformer. And everyone will tell you you're wrong in the beginning because it's real choppy. It kind of stinks to hold the beginning of it because you're going to get through this chop here. So you'll get these big up and down movements, big 50% pullbacks. It's pretty rough. But this is what I think is coming in commodities a few years out. The valuations support that opinion. The interest rates going up supports that opinion. It's all those things interconnected for me to develop my opinions about this.
Wow. Well, I can't think of a better note to end things on, unless you have anything else you want to talk about, Andy, that we didn't get to before we wrap up here.
I could just do a quick thing, just saying like what sectors I think look pretty good.
Yeah,
that
go
are
ahead.
down right now. Just if people want to follow, but uranium looks really good. I think that looks like a very promising sector right now. I think lithium looks really good. A lot of the oil companies are down. They still might have to chop sideways for a while before heading higher, but there is incredible value in energy service in some of the oil companies. Energy service looks ridiculously cheap. So if you're a long-term investor and you're looking at potential sectors, look for stuff that's down right now. I even think the mining companies look pretty good for precious metals and platinum group metals. The whole commodity space looks ridiculous from a valuation perspective now. We're going through these big bottoms, and it's going to take some time. But I think people who position now when everybody's not looking at it will do absolutely killer over the next decade. I mean, absolute massive outperformance. I think this NVIDIA chart is going to be what commodity companies look like over the next, say, 5, 10, 15, 20 years. And I think that people aren't going to, they're not going to be able to ride through maybe the beginning portion because it's so volatile and it gets frustrating and boring in the beginning, but it will come and the money's going to rotate. And what you want to watch for that rotation is the dollar and yields moving up, dollar moving down, and that will be the driver of the commodity bull market that I think has started in 2020 and will continue out in the future.
All right. Well, Andy, thank you so much for coming on, my friend. Where can people find you if they want to hear and see more of you?
Yeah, so if you guys like what you saw and want to learn more, we've got 2 spots you can follow me. YouTube, which is Finding Value Finance. I do daily videos there. I don't go as deep into everything as I do on the website. We've got these question and answer sessions that we do on the weekends, and I dive pretty deep into all this stuff and the individual companies. We do conference calls. We do all sorts of stuff on those. So that's finding-value.com. That's the website if you'd like to join there.
All right. Well, thank you so much for coming on, Andy. Guys, if you enjoyed this podcast, remember to give us a like and comment. Go, Andy, go in the comments section. It really does help us in the algorithm and does help boost the channel along the way. It's a very it's free and it's very easy to do. You can also support us on my Substack at capitalcosm.substack.com, where you can become a paid member and get access to all of my stuff early, ad-free, and uncensored for the interviews that warrant it. And then also subscribe to the YouTube channel as well. That also helps boost us in the algorithm. So any little bit of help does go a long way. So thank you so much for watching, guys, and I will catch you in the next episode. Bye, y'all.